All right, 12 o'clock. We're going to start on time here. I appreciate everyone for joining me today. My name is Adam Stern. I'm CEO of Strata SFR. We're a Bill for Rent company. Wanted to do this webinar because I spend most of my time doing two basic things. Number one, talking to builders, developers, intermediaries, land developers, lot developers, landowners, trying to key into good Bill for Rent deals. And the other half of my time is spent analyzing projects to try to figure out which ones make good Bill for Rent projects and which ones don't. And I thought it might be fun to do a live session here to kind of show everyone how I look at things, what the numbers look like, what I look for. So I thought I'd start from a high level, kind of giving everyone a sense of where the Bill for Rent market is right now. When I started Strata back in January, I was mainly calling builders, asking them to sell finished products to my clients, meaning the builders took all the risk, they developed the land, they built the units, they created essentially a finished product, they sold at C of O. More and more what I'm finding is builders aren't willing to do that anymore, which means I have to swim further upstream and start talking to lot developers to compete with those builders so that my clients can buy the lots and then hire builders to build their homes for a fee. Recently, that's been becoming even more and more tough since the residential housing market's been going bonkers, and I've been swimming even further upstream to find landowners that have entitled lots, meaning there's nothing built on them, there's no lots available or built or developed on the land. They're just zoned, essentially, where my buyers would come in, buy the land, and then hire a lot developer, and then hire a builder to do the build for the finished units. So today I'm going to be reviewing 4 deals that are somewhere in the realm of being entitled land all the way through finished lots, where I've kind of analyzed them as such, and I thought I'd go over kind of what I look for at a high level, at least, to figure out, number one, if the development kind of fits the criteria of what I look for at a high level, and then if it does, do the numbers look good? And if both those things pan out, I consider it a worthwhile Bill for Rent project to package up and then deliver to Strata's network of institutional buyers, private equity firms, operators, people that want to gain more exposure to the SFR market. So kind of with that, I'm going to breeze through all 4 of these projects. I'm not going to take any questions until the end. To the extent anyone has any questions about any of these projects, hold on for 1 second. I got to plug in my computer. Technical difficulties. Hold on for 1 sec. That's me not preparing correctly. So to start off with, everyone that knows real estate knows real estate's all about location. So kind of think about the criteria that we look for first whenever a Bill for Rent opportunity is kind of identified. The first thing's obviously the location, right? The 3 main things that I always look for in terms of location are, number 1, proximity to roads, proximity to interstates. The second is proximity to population centers. And the last is proximity to amenities. In all 4 of these, I'll actually identify all 3 of those 3 components and show you why I think these projects are worthwhile. So location is number 1. Number 2 is tailwinds. Once I figure out where the dirt is and whether or not it kind of fills or checks these 3 boxes, I look for the tailwinds of the market, meaning there has to be something going on with the market that's going to make it seem like a good investment opportunity for the next 5, 10 or more years. I call those tailwinds. I look for economic trends and population trends. If people are moving to an area, they're usually moving to an area for a couple of reasons. Number 1 is jobs. Number 2 is lifestyle and cost of living. So when I look at these projects, I'll kind of go over that as well. And then once these things are kind of looked at and confirmed, then I look at the numbers. And for all 4 of these projects, what I'll be doing is I'll be going over the numbers and showing you how we figure out what the returns are and what they need to be in order for them to be interesting to us. So with that, I'm going to bring up kind of the first deal here, which is a project called, which is a 150 townhome development in a place called Commerce, Georgia. Okay, so before I kind of dive into anything else, let's look at the location first. So if you look at the location of Commerce, Georgia, and you swing up and you look at where Commerce is in relation to Atlanta proper, it's a ways away. This is not exactly a bedroom community of Atlanta. I would consider this a bedroom community. It's about 70 miles northeast of Atlanta. So it's not going to necessarily benefit from a lot of the fundamentals of Atlanta, but if you look closer, you see that the land is just adjacent to some older subdivisions, some already built out subdivisions. But you think about those three check boxes: proximity to interstate, proximity to population, and proximity to population trends or population. Or what you'll see in this deal, in the Commerce deal, the land is well positioned. And if you kind of look at a map, which I have here for Commerce, Georgia, you'll kind of see what I see. So this is the place where the subdivision is slated to go. I look at it and I look for proximity to an interstate. So you can see that Commerce, Georgia is right off the Interstate 85, and this site that we plan on building on is within probably a 10-minute drive to the interstate. So, it checks the first box. It's close to an interstate. You look at it in terms of proximity to a population center. Commerce is not a big town. Commerce is not in itself a huge population center, but it is a population center. It has all the amenities like restaurants and retail that you would expect in a thriving town. So both those things were fine. But here was the interesting thing about Commerce. The tailwind for the market was really the driving factor here. And what I found out about Commerce, being that the dirt is well located and being that the actual location is close to an interstate, I looked at this new tailwind as being almost like a no-brainer. There's a company called SK Innovation, which is a EV battery producer. They produce batteries for hybrid and electric cars. They just built a $1.6 billion facility. It's built, it's functioning. They have about 200 employees there right now, and they plan on hiring another 2,600 employees over the next few years. Now, me being the ever inquisitive guy that I am, I called up people around town that knew about the SK Innovation Plan. And what I found out is a lot of the employees that they're going to be hiring are actually going to be coming from overseas. And when I talked to rental companies in there, what I found out was because these people speak a common language and they have a common culture, they really want to live close to each other. So as of right now, they're actually doubling up families in Commerce in rental properties because there's just not enough rental stock. So if you think about the opportunity to build what this is a 150 unit subdivision in one area that's literally 5 minutes from the SK plant, you think about if you work there, it's really a very strong value proposition to work at SK and to live in a full rental community that's just minutes from the site. If that wasn't good enough, there was another site that was just built there in 2018, which was the GE plant. GE Appliances built a smart warehouse in Commerce in 2018, $55 million. It's totally up and functioning right there. It only employs about 100 people. But when you have this much building for industry going around, what you get besides the actual employees that work for the site is you get retail shops, you got restaurants, you get businesses that come to the area because there's a higher demand for those services. So I looked at this and thought, what a great opportunity to build a good, solid, large build for rent deal. The dirt's well positioned. There's tailwinds to the market. It's close to the interstate. It's close to population centers. And if you look at the actual map here, you'll see it's right next to retail, including Walmart, Tanger outlets, and all along this corridor, you have restaurants, you have retail, you have all the things and amenities that people look for. This is the site. This is the SK plant. This is the GE plant. Couldn't be better positioned. So then I dug into the numbers. All right. And here's how the numbers looked. And this is how we go and analyze most deals. We really break it down into three different components. It's the land costs, it's the building costs, and then it's the income and expenses, right? So for this deal, we knew that someone could come in and the builder who brought us the deal actually already has this under contract. Here's the lot costs for entitled dirt. It's $16,000 an acre. I'm sorry, $16,000 a lot. So $16,000 per lot. There's gonna be 150 lots on the site. We worked with the builder to figure out the lot development cost. They pinned it at about $35,000. So the total lot price is this. We figured in Strata's fee. So the total lot cost is about $54,000, which is great. We worked out a deal with the builder that saw the building price per square foot of the units they can build being about $61 a square foot, which means the all-in cost to build, including builder profit per unit here, is going to be about 136, 137. And we add those two numbers together, you get an all-in cost per unit of $190,000 per unit. Average size unit is going to be about 2,000 square feet, right? Which means it's a 150 unit subdivision filled with 2,000 square foot homes that the builder is really good at building. They build a quality products and they always come in on time and on budget. We pulled rental comps, which you'll see right here, and we pulled sales comps. That informed us that that unit should rent out for an average of $1,630 per month, okay? Smaller unit will rent out for $1,530, large unit should rent out for about $1,800. And that informed us about how we can get to a cap rate. We layered in actual taxes using a millage rate. We layered in management fees, insurance costs. We figured an HOA fee and maintenance reserves. And when I go down and look at the expense load, I need that number to look and to be anywhere between 35 and 40%. Generally, no matter where we go in a good build-for-rent market, the expense load is going to range between 35 and 40%. This landed at a 36% expense load, meaning we got to a total operating budget of X. And here's where it all kind of comes into sharper focus. This deal, if my numbers play out correctly, should be a 10.2, 10.3% gross yield, which equates to about a 6.2% net yield, right? I know that most institutional investors for this kind of development risk are going to want to land somewhere between 6% on the extreme low end all the way up to about 6.5, maybe even higher. And because these numbers are what they are, if my numbers play out correctly, we're right in the middle of that range. We're at 6.2%. So what Strata does is we don't necessarily go out there and take listings. We go out there and find quality projects. We put all the puzzle pieces together, the lot developer, lot owner, the builder, and ultimately put those things together and deliver a project to an institutional investor that has to understand all these things in order to make a play for it. So that's Commerce, Georgia. Going to the next one, I'm going to talk about a market that most people really don't know about. It's in a submarket of Memphis, okay? A lot of people don't like Memphis. It's generally known as a cash flow market. This site is a bedroom community of Memphis proper. So if you look at this one, it's about a half an hour away from Memphis. Here's the site. Here's Memphis. It's along Route 51, which is a straight shot up to a place called Millington. Millington has some interesting things. So we kind of go along the same path of analyzing this property. First, looking at the dirt, right? First, we want to know that the dirt's well located. It's close to population centers, which we already know. It's close to Memphis. And we also want to make sure it's close to a throughway. Route 51, not a major throughway, but major enough, leading right down to Memphis, so it's easy to get to. Here's the site. It's this patch of dirt right here. What's interesting about this is a lot of major builders are buying up land along this corridor. And what's following is a number of new retail shops, including a supermarket, Walmarts are being opened here, Starbucks are being opened here, and already existing subdivisions have already sprouted up. They're already in play right now. So you have dirt close to close to a population center, close to a major roadway, and the next thing is looking for a tailwind. And this is interesting. So if I looked at the tailwinds for the market, what I look at is what's going to drive renter demand for the years to come. And in Millington, there is a place, there's a naval base. It's one of the most important naval bases in the U.S. It's called the Naval Base Southeast. It has a few thousand troops that are stationed there, with about 100 being added every year. So there's an embedded renter base of military personnel, which they're already short on rental housing. So if you combine the fact that the military base is there, and you combine the fact that you'll see here the NSA Mid-South is right down there, and you combine the fact that people, because of COVID, are just fleeing major population centers around cities like Memphis. The place they're fleeing to is Millington right now, and that's going to continue for years to come, I think. So the idea behind starting a for-rent subdivision over here is most of the subdivisions that are going on right now are for sale, and there is, from what I can tell, a pretty constrained amount of single-family rental properties. So it's kind of got all these components: the population, the proximity to throughways, and it's got this tailwind of not only the military base, but also population moving out from Memphis to have more room and want to live in single-family rentals. So now that we kind of know the fundamentals, you kind of dig into what the numbers are. And with this site, I was brought this site by a close colleague of mine. I've got a builder lined up that has their hands on the site. They're able to build the homes, deliver the lots, and deliver the homes. And here's what the numbers look like. The lot price is about $9,000. That's for an entitled lot. You can develop that lot for about $23,000. So the all-in price for that lot finished is $32,000. If you added in what the builder said they can build these units for, what we thought would work well is a 1,800 square foot unit and a 2,000 square foot unit. So the builder's pretty sure they can build for $72 a square foot, which means the build cost is about $136,000, $137,000 from foundation to roof. If you add those two things together, between the two model types, you're talking about an all-in price point of $171,000, $172,000 per finished house, right? We went and we looked at rental comps and sales comps, and we looked at those units being able to rent for $1,600 and $1,700 respectively. So for an average square footage of about 1,888 square feet, that unit should rent out for about $1,650. And using kind of the same methodology of figuring expenses, here's what the taxes on a unit will be. We figured in management rates and insurance costs and maintenance costs and an HOA fee. The expense load came to a little bit higher than the last project, about 38%, which means the NOI is lower, the net operating income is lower. But here's the way the gross yields panned out: 11.4, 11.5% for the gross yield, and 6.7, 6.6% for the net yields. Now, this is higher than Atlanta, and it needs to be higher for Atlanta because this is the South. This is Memphis. Generally, people look for higher yields in a place like Memphis. So I knew that I needed to get to a higher net yield to make this a viable project, which is exactly what it offered. So what we have right now is we have a builder who has the land. We've got the builder that can build the units, and we've got a good census to make a really good build for rent community. It's worth noting that when I look at fair market value price, I look at what we could build the units for and versus what they'll actually be worth fair market value based upon the comparable sales. And that informs my number that you see right here, which is a discount to market. The commerce site I just talked about is about a 13, 14% discount to market. This one would give you about a 21, 22% discount to market, which for a place like Memphis and for a real estate market as hot as Millington, I think is a pretty good deal. So that's Millington. Kind of moving along here, the next site I'm going to talk about is a site that I don't think a lot of people a lot of institutional investors are yet looking at. It's a site in South Carolina. It's a market in South Carolina called Greenville. Greenville, if you look at the tailwinds, I don't know a whole hell of a lot other than the fact that most major national home builders are doing projects here. People are moving there. Cost of living is relatively low. There's a lot of industry there. And, you think about if you're a small business owner and you look at things like where the Walmart's going, where the Starbucks are going, where home improvement and retail is going. If you look at the dirt for this project, it couldn't be more well positioned. It's right up a place called Stenhouse Road. It sits right adjacent to a Walmart. It sits right in front of an already existing, newly built subdivision. And we're planning on putting about 95 townhomes right here. So in terms of the dirt, you think, again, is it close to major interstates? Absolutely. It's just a stone's throw away from I-85 that runs right through Greenville. It's surrounded by amenities. It's surrounded by shops, Walmarts, retail, and it's surrounded by builders building other for sale subdivisions, which means population's moving there. Okay, so we thought that the dirt on this could not be better positioned, and what we're able to do is we got brought this deal, and the dirt is actually owned by owned in 4 separate parcels that they were able to put together. It's about 8.3 acres altogether. And we did the numbers. So what we're able to do on this site is figure out what the lot price was going to be, assuming 95 lots would go there. We basically figured in what the asking price for the dirt was. We talked to a local land and lot developer who we're still working with, who informed me that we should be able to land around $25,000 per developed lot. You know, you add on Strata's fee, you're at about $46,000 per lot, which isn't great, but it's certainly not bad, and it certainly doesn't put the subdivision out of contention. We lined up with a builder that can build units for about $80 a square foot for the smaller units, and about $75 a square foot for the larger unit. So we averaged out about $131,000, $132,000 from foundation to roof, and a finished unit should be able to be built for all in about $177,000 to $182,000 a unit, which equates to a smaller discount to the retail market, but it's a really good location. So that to me was palatable. We figured that the rents here should go for about $1,600 a month for the smaller units, about $1,750 for the larger units. These numbers are conservative. I think we could probably do better than this. Given the fact that it's so close to all of the things that this area of Greenville has to offer. We went and we figured out the same expenses. This came out to be, you know, just like I said, it needs to land between a 35 and 40% expense load. This one landed at 38, almost on the nose. So all in, this one landed at about a 10.9, 11% gross yield, which should get the buyer about a 6.4, 6.5% cap rate at the end of the day, which to me, for a place like Greenville, I mean, you know, not everyone's there yet, but I think people will end up going there because the opportunity to build a portfolio in a place like Greenville as opposed to like Raleigh or a place like Charlotte, I think there's a better opportunity there because there's less competition right now. And the opportunity to actually get something on a 6.5 where maybe in 2 or 3 years, you're gonna be looking at cap rates in the high 5s, I think it's a pretty solid thing. So that is our Greenville opportunity. And I wanted to end off on kind of a more opportunistic site that is right outside Charlotte in a place called Troutman. Everyone can pretty much universally agree that Charlotte is a hot market, that it's a good place to invest your money. Troutman is just north of Charlotte. It's about, I'd say, 40 minutes outside of Charlotte proper. So if you look at Troutman, on a map, it's a straight shot up I-77 from Charlotte, right? So it's not a very close bedroom community, but it's certainly considered a bedroom community of Charlotte. And the fact that this site is so close to I-77, in fact, this site is right off I-77. It was brought to me by a contact that actually owns the land. And check this out. So this site was actually sold to a firm that was going to bring in a Walmart back when they were doing super centers. Lately, I don't know if you guys know about Walmart, but they actually moved to smaller stores. So they're moving away from super centers to smaller stores. And because of that trend, Walmart actually didn't move ahead with doing a super center right along 77 on the site. So this ended up getting bought back or owned again by the original owner. And this parcel includes 12 different lots, right? They could certainly bring in other retailers. This would make a fine retail establishment. You could bring retailers to retail a major place like Walmart, having hotels and retail shops around. But I thought it would make a phenomenal build for rent opportunity. So what the owner told me is he's talking to a high-end apartment company that wants to go in and build high-end apartments, high-density apartments where Walmart was going to go. And that gives us the opportunity to build maybe a townhome project in these other out parcels where if a developer with the right skill set can come in and either buy all 60 acres, develop these lots as townhome lots and partner by either partner with the apartment developer or developing the lots and then selling the parcel that the apartments would go on to another developer, this other developer, it would be a home run, I think. So the opportunity, and again, this is really opportunistic, you could buy any one of these lots and build single family on it, and then have the current owner sell the other lots to retailers and this apartment fund. Or if you have a lot of lot development prowess, you could buy all the lots, develop them to the extent you can, and then make profit by selling the lots to the retailer and the apartment fund. And you can create a really good, solid single family townhome development that's right adjacent to a high-end apartment building with retail shops in the outskirts. And the fact that it's on I-77 right now, it's just, you look at how many opportunities there are for this kind of parcel on I-77, this close to Charlotte, and this is probably going to be one of the only ones you see in this kind of proximity. So I thought it would be a really good opportunity for someone that might come in and want to do some lot development and eventually build a single family rental subdivision. So that is the fourth project. Okay, so closing thought, built for rent, great space, ton of opportunity. You know, if you look at how much of the U.S. housing market is actually owned by institutional investors, less than 2% of the entire population of all the housing in the United States is owned by institutions, which means we've got, you know, to my estimation, another 10 or more years of this market being probably as hot as it has been, with as much opportunity as one could hope for. You know, if you're a lot developer, land developer, builder, and you've got projects that you think might make good built for rent opportunities, not only can we analyze them for you, not only can we tell you what the price points might be for the lots, or not only can we introduce you to builders, we can give you a really solid analysis and tell you why it would or wouldn't work. So I'll invite everyone to connect with me offline. And again, appreciate everyone joining me. Thanks for watching. I'll see you.